All right, so you're weighing the pros and cons of real estate investing, and you hear these two terms thrown around everywhere: cash flow and appreciation. It can get confusing, can't it? Which is preferable? Well, the truth is, they are the two fundamental ways you make money in real estate, and the path that you choose completely depends on your own financial goals, your lifestyle, and honestly, your personality. Do you desire steady cash flow now, or are you playing the long game to build enormous wealth? That's what we're going to analyze today. So let's outline the two options very clearly. First, you've got the cash flow strategy. This is unadulterated now. It's maximizing that immediate, consistent rental income you get every single month. This is your paycheck from a property. This is for people who like stability. You're not trying to time the market. You're building a business that has consistent, predictable income to live on, pay bills, or reinvest. And then there's the appreciation strategy. This is the long-term game. Appreciation is the appreciation of the value of the property over a period of time. You don't necessarily realize this money until you sell the property or borrow against the property. The appreciation is gradual, but when you do cash out, the gain is huge, tend to be the majority of your total return. It's a waiting game and making an educated guess regarding future appreciation. Now, which path is for you? Let's talk about two common investor profiles. If you're an income replacement investor, you're probably looking for stable, passive income. You might need to pay for your living expenses, aim for financial independence, or retire early. You are going to love cash flow. You look for properties that give you a reliable monthly check. Predictability is your friend, and you don't mind speculative, explosive growth as much. On the other hand, if you're a portfolio accumulation investor, you're interested in accumulating your net worth as rapidly as possible. Appreciation is your top concern. You're in the equity compounding and leverage business. That is, another name for debt, to amass your wealth with all due haste. Such investors often use sophisticated tools like the 1031 exchange, which I'll cover later, to defer taxes and keep that growth machine running. Your time horizon is most likely the most important consideration in this situation. It's the critical determinant. If you have a short-term horizon, 1 to 3 years, you just need to focus on positive cash flow. You just don't have the patience to weather a market decline. You want that income to be coming right now. But if you have a 7-year or more horizon, that's when appreciation strategies really pay off. You can weather the ups and downs of the market and let the force of compounding take effect and significantly enhance your property's worth. And if you're in the middle with a medium-term 3 to 7 year plan, you can do both. You can take some market risk and still keep your income needs. This literally addresses the different attitude. Cash flow is all about being predictable. You calculate it using numbers you already know today: the rental income, the cost of operation, the mortgage payment. It gives you a wonderful degree of confidence, which removes a great deal of financial and psychological strain. Appreciation is more speculative and more complex. It's founded on forecasting the future, economic cycles, population shifts, demand and supply. You're essentially wagering on where the market's headed. It's a matter of market timing, and market timing, by its very definition, involves more risk. Okay, now let's get into some crucial numbers, starting with the king of them all: net operating income, or NOI. That's the most important number in commercial real estate. NOI tells you how profitable the property is before you factor in your mortgage, taxes, or significant capital expenses. It's simple. You take all the rents and other income, and you subtract all the direct operating expenses, like utilities, property management, and maintenance. What you're left with is your NOI. Why is this so significant? Because it distinguishes the true operating performance of the property. It lets you compare two very different properties on a level playing field, regardless of how much debt one owner utilized and another. It's the bare health of the income stream. Then comes the capitalization rate, or cap rate. It's an important valuation metric. It's calculated by the NOI divided by the market value of the property. Think of the cap rate as what your current yield is on the property. A higher cap rate, for instance 8%, usually means you are getting a higher current return, but usually signifies a higher risk property, maybe in a secondary market that places more emphasis on cash flow versus long-term growth. A lower cap rate, nevertheless, like 4%, nevertheless means a lower initial yield, but they're typically in prime, stable locations where everybody's expecting gargantuan appreciation later on. So you're sacrificing cash flow today for appreciation tomorrow. And finally, my favorite income investor metric personally, cash on cash return. This is actually the real measurement of what you actually receive back on your money after paying the bank. It calculates your pre-tax yearly cash flow. So that is your NOI minus your yearly mortgage payment, divided by the actual cash you actually put up out of pocket, your down payment and closing costs. This is such a powerful measurement because it will tell you the magic and danger of leverage. It answers the question, what is my real percentage return on the actual cash I put in? And that brings us to the power and danger of leverage. Leverage can propel your returns into orbit. Let's have a quick example. Imagine a piece of real estate that would give you 6.7% if you bought it all with cash. But if you put up some money and borrow the rest of it, your cash-on-cash return could be doubled to 10%. That is the leverage magic. You're getting a higher return on less of your own capital. But here's the catch. While debt maximizes your return, it also puts you at risk. When the interest rates go up, your mortgage payment goes up, and it hits your cash flow directly. That fantastic 10% return can vanish to a zero or become a negative very quickly. Leverage is a double-edged sword. So let's talk about appreciation. Appreciation is the increase in your property's value over time. This is unrealized gain. You don't realize the cash until you sell. Real estate tends to appreciate at a slow but steady pace, versus an asset such as the stock market. Historically, the U.S. real estate market appreciates at a rate of 3 to 5% per year. But as you can see, there are certain areas of high demand that will see supernormal appreciation, like Montgomery, Alabama, or Baton Rouge, Louisiana, more recently with appreciation over 20%. That's the dream, but not the norm. So what actually drives the growth then? A couple of things. One is macroeconomic drivers, solid job markets, inflation that raises the cost to build new homes, and low interest rates that allow people to buy. And local demand and supply, of course. Is it a growing city? Are more people moving in than houses to accommodate them? This is enormous. And then, of course, micro-level improvements. Is there a new school being built? A new hospital? A new railroad? These kinds of local investments can cause property values in the neighborhood to skyrocket. Now, projecting appreciation is where it gets dicey and unknown. It is not a precise science. To be successful at it, you must analyze historical data, current economic indicators, and use predictive models, even such cutting-edge concepts as machine learning and demographic projection to try to predict the market cycles. You're looking at the average price change, volatility in the market, and the average duration of its expansion and contraction phases. Getting this right is critical to an appreciation strategy because your entire profit relies on that figure in the future. And something that influences both strategies greatly is interest rates. When interest rates rise, it's a headwind for everyone. For cash flow, higher rates mean your cost of borrowing goes up. If you have a variable rate loan, your mortgage payment is higher, reducing your cash flow and your cash-on-cash return directly. For appreciation, higher rates make it more expensive for everyone to borrow. This reduces the number of qualified buyers, causing less demand and capping off how much prices can appreciate. You could end up holding the property longer than you had hoped, waiting for things to improve. This is so important that it drives your entire strategy. The country is really divided into two types of markets. You have cash flow markets. These are typically smaller cities or secondary markets, typically found in the Midwest and South. The cost of real estate is not so high. Tenant demand is strong, and you can acquire properties that give you enormous monthly cash flow from the get-go. Then there are appreciation hubs. Think of Tier 1 cities like San Francisco and New York. They're wonderfully pricey, and in the process of that, the cap rates get compressed. You can even have a negative cash flow when you buy. but you're counting on the incredible rate of appreciation to make you a millionaire in the future. And that creates two very different uses of debt. With a cash flow strategy, you use as much debt as possible to create positive arbitrage. That's just another way of describing the fact the income on the property is greater than the cost of its debt. You're squeezing that cash-on-cash return with fixed payments. In an appreciation strategy, you borrow money to use the largest asset you have at your disposal. Even if negative arbitrage is the result, losing money every month, you're betting that the appreciation of the property will be so extreme that it will be more than those monthly losses when you sell. The cash flow from other properties can be applied to smooth out these losses while you wait. Okay, here's one of the best things about investing in real estate: the tax benefit of depreciation. The IRS lets you deduct the theoretical wear and tear on your building, even though it's actually gaining value. Residential ones depreciate over 27.5 years, and commercial ones over 39 years. That's a non-cash cost. You don't actually write a check for it. Just it provides you with paper losses on your tax return. Those losses can be offset against your rental income, or even other income such as your salary, reducing your taxes by a fortune and enhancing your effective take-home cash flow. It's a big advantage. And for you appreciation investors, this is your dirty little secret: the 1031 exchange. It's a magic loophole that lets you put off capital gains taxes when you're selling a property, as long as you reinvest the proceeds in another like-kind investment property. The regulations are strict. You have to locate a new property in 45 days and 180 days overall to finalize on the new one. The new property should also be of equal or higher value. If you repeat this process again and again, you can roll your profits over for decades, letting your capital build without the government carving off a piece each time. It is the key vehicle for building generational wealth through appreciation in property. Well, of course, both strategies have risks that are quite different. Cash flow risks are high vacancy, no tenant, no cash flow, potentially disastrous. And there's expense creep, where property taxes or insurance go through the roof, devouring your profit. And sometimes, these properties are more difficult to sell immediately. Appreciation risks are all about timing in the market. If you're wrong on the market cycle, an economic downturn can wipe out your profits. There is regulatory risk, like new rent control laws or zoning changes, that can kill your property value proposition. So what do the pros do? They don't do one, they do both. They use a hybrid strategy. They establish a foundation of stable, cash-generating properties, such as secondary market multifamily, to cover bills and build security. And then they invest capital into growth appreciation assets to build their long-term wealth. The magic link between them is the cash-out refinance. As your appreciation properties grow, refinance the loan, take out your built-up equity tax-free, and invest that money in buying other income-producing properties. It creates a perpetuating rhythm of equilibrium between safety and rapid expansion. So, in summary, the choice between cash flow and appreciation is primary. It's about designing your individual financial architecture. Cash flow offers you predictable income and is wonderful for lower risk tolerance and shorter horizon. But watch out for vacancies and rising rates. Appreciation builds massive long-term wealth with tax-deferred compounding. But it has a lengthy horizon needed, and you have to withstand more volatility. The pro play is to consolidate them: appreciation to build wealth, refinance to extract cash, and then invest in more cash-flowing properties. That's how you build a self-sustaining, dominant real estate investment portfolio that pays for your lifestyle and builds your legacy. If you like this video and wish to proceed with your real estate learning, then subscribe to the channel and hit the bell so that you can know what's in store next. To keep your momentum rolling, I've chosen another video for you that will help you in your investing journey. You'll see it right here on the screen. Just click it and go ahead and learn some more. Thanks for watching. I'll see you in the next one.